Good afternoon, Quasar Markets Live. We have such a great segment for you here. We are back with our third segment with Dr. Alan Ellman, the president of the Blue Collar Investing Corp. I've asked him to go over a little bit about his portfolio and how he diversifies and how he allocates cash. We've gone over his covered call program, a little bit of his strategy and what he does there. So, Alan, thank you for joining me today. How are you doing the day after the election?
Not much sleep last night, but doing great, Howard.
That's awesome. That is awesome to hear. Again, thank you for joining me. We're going to get right into it. So, you've put together a PowerPoint for us. One of the things that I've been so impressed with your program is not only do you have a strategy that you've come up with over 30 years when it comes to, using covered call writing as a way to limit risk and increase your profits, but you also have put together a very dynamic stock screener and selection portfolio sort of management into this too that you tie in. So can you tell me a little bit more about that?
Well, everything we do in the BCI methodology is about throwing the odds in your favor. And uh, I do dozens and dozens of things that may seem a little intimidating initially to a new investor, but after a while, it just becomes very much second nature. Now, the last time we spoke, Howard, I showed you and your viewers a few reports that we provide to our members for option trading. And so we have a list we screen from fundamental, technical, and common sense perspectives to get a quality list of securities. They could be stocks or exchange traded funds. But that's not the end of it. How do we populate our portfolio and throw the odds even more in our favor in
Right.
terms of minimizing risk? And so, what I'd like to talk to you about today, and you asked me to do this, was how we diversify and how we decide on how much cash to allocate in our portfolio. What process do we use?
Absolutely.
So
That's so important.
it's very important because if you have a portfolio that has, for example, um, four gold ETFs and one computer hardware stock, and gold all of a sudden has a severe downturn, your entire portfolio goes down.
Right.
Whereas if you were diversified and you had an equal amount of cash in each position, well, then your portfolio will be affected, but not to a dramatic extent. So I see you have the slide on what is diversification. And once again, this is all about risk management. So when we try to have as many different stocks or exchange traded funds, because that's what I use as the underlying securities when I use covered call writing or selling cash secured puts. So well, we try to have as many as we can and manageable. We should be able to manage that number of positions, and each investor can decide what is a manageable number for them. For me, it's usually between 20 and 25 positions, a few in my mom's account, and probably 100 to 150 contracts every month. So that's my comfort level.
Right.
Some people may have less, some people have more, but that's what I do. Now, in addition to uh, diversifying with stock and or ETF, also industry segments. So
Right.
you don't want to have all gold or like I said, all computer hardware. You want to be diversified in that regard as well. And you don't want any one particular security or industry to dominate your portfolio.
Makes a lot of sense. We see that as a problem for a lot of people is that they think they're diversifying because they buy 10 different stocks, but if those 10 different stocks are Nvidia, Intel, AMD, and SMCI, you are really just investing in a sector by itself. So I love to see that that is the way you guys look at it for sure.
Yeah, if you see a sector like the chips sector is doing very well, and you see these stocks are high flying, then you might tend to get all chips related
Yeah.
securities. And then what happens? 2 weeks later, it's going in the opposite direction, and you figured, how could I have misjudged this? But you didn't diversify.
The other thing I would like to touch on that you just said is because I think it goes right in line with what my personal feeling is on holdings. You basically said it's about 1/20th of a holding is about 1/20th of your portfolio. You like to have 20 to 25 moving, and then you have the options and everything off of that. But when you look at it, to me, it would be like that type of 5% sort of, cap towards your, any one holding. I think that's important. A lot of different investors don't look at that. And, if they have $10,000, just to pick a round number, they're doing that in one or two trades. You need to diversify into more. That, too many eggs in one basket, just from your risk management or your health, isn't a good idea.
Yeah, but we have members that have 15,000 to invest, and we have members that have millions to invest.
Right.
So if you have limited cash, then you're going to have less securities, and that's where you may want to turn to ETFs, where you have baskets of stocks to better diversify than maybe three
Absolutely.
or four stocks.
Yeah, and you pointed out that in our last conversation, so it's definitely a great point. ETFs give you that little bit of a broader, so it's not one company, at least the sector. I was looking today at one point in the Spider 11 sector ETFs, 10 of the 11 were up. So today was a day that it wasn't too hard to pick the winner, I guess, at least early. That's going to probably
Yeah,
change throughout
today's
the
not going
day.
to be a typical day,
Yeah, I
but
know.
yeah. Well, in addition to diversification, you have the slide up now on cash allocation. So, how do we determine how much cash we should allocate per position? And we actually have developed a spreadsheet to do this, and that's going to be in the next few slides. But first, let's define for your viewers what is cash allocation, and that's where we apportion a similar amount of cash. It'll almost never be exact,
Right.
but a similar amount per position. So here's how we do it. We take the total amount of cash that's available for that portfolio, and we divide that by the number of positions we're going to take. And then what we do is that tells us how much cash per position we're going to allocate. Then we divide the price per share into that amount, and that will give us a certain number of shares that we could purchase. And then we round that up or down depending on if it's above or below 50. And that will tell us how many shares we're going to purchase, because for every one option we sell, we must own 100 shares of that underlying security to be covered or protected. And so, as I said before, we've developed the BCI portfolio setup spreadsheet that will do all the math and heavy lifting for us. Now, what you're showing here, Howard, is one of the screenshots from our last discussion. And this is from our premium member stock screen and watch list, which we publish for our members on weekends. So it's updated every week. And I highlighted three of the securities on that list: ANF, Abercrombie and Fitch, DocuSign, and Broadcom,
Yeah.
Avco. So those are the three that we're going to use. Plus, oh, by the way, you could see that red arrow shows the securities that are in the white cells that don't have upcoming earnings, because we always avoid earnings report. So
Absolutely.
we're going to take three of those, base it on the price at the time that this report was published. And if you go to the next slide, I'm also showing you a screenshot of our exchange traded fund ETF report, which is published midweek for all of our members. And here we have financials and materials that are from that select sector spider you were mentioning before. And so we're going to use those three stocks and those two ETFs.
Okay.
And if you move on to the next slide, we're going to do it in a portfolio, in this hypothetical portfolio, Howard, that has 150,000.
Okay.
So the way you do it in the spreadsheet is you put the contract month and year. So for the November monthly expiration, 2024, you put in the blue cells, and the expiration date is the 15th. And at the time, there were 16 trading days left until expiration. That'll be updated every day automatically. Now, you'll notice that we entered 150,005 positions, and below, in the next section below, which I'll show you on the next screenshot, but don't go there yet,
Yep.
um, it'll do some math and break it up into how much per position. But what I want to show you here is in the yellow cells, it tells you how much cash reserve you should set aside. In other words, you shouldn't use for purchasing underlying securities. This will be our cash reserve to use if an exit strategy opportunity comes about. And it would always start with buying back the option. So if we use the entire 150 to buy stocks, and now all of a sudden the price of the stock goes down, the value of the option goes down, you could buy it back at a discount. Where's the money going to come from?
Right.
So you have to have a reservoir of cash. The guideline I use for our members is 2 to 4% of the portfolio value, which in this case is 3 to 6,000. That'll
Okay.
fill in automatically once you put in 150,000 with that will give you your 2 to 4%.
Right.
Okay.
That's
Now, if you
great.
move on to the next slide. Now, on the spreadsheet, below that section you just saw, I couldn't show you everything in one screenshot because it would be too small.
Right.
But what you saw in the last screenshot was the top. And then on the bottom, there's a left and a right section. This is the left section, which gives you the initial setup based on the information that we're about to enter. So in the blue cells all the way to the left, you see the ticker symbols of the 5 securities that we alluded to before: ANF, DOCU, AVCO, XLB Materials, XLF Financials. Now the spreadsheet tells us 30 grand per position. Then we enter into the blue cells the price per share. So if you look at ANF, for example, at the time, it was 156.73.
Yeah.
Now the spreadsheet will then do the math for us and tell us, based on 30 grand, we could buy 191 shares of ANF. Now the spreadsheet will then round it up because it's above 50 to 200.
Yeah.
And therefore we could sell 2 contracts. It will then tell us that purchasing 200 shares will cost us 31,346, and we can enter the industry just to make sure that we're properly diversified, which you can
Right.
see here we are. Now, if you take a look at the one below it, DOCU, that calculated out to 415 shares, which was rounded down. Now, we don't have to go through all the rest. It will then do a calculation for us. The total spent in the second from the bottom is 153,286.
Yeah.
Guess what? We only have 150. So we are in arrears 3286. That means that for the final setup, now a lot of times the initial will work out fine, but if it doesn't, we have to make an adjustment.
Adjustment.
So we need to make up for that 3286, plus we need a cash reserve of about 3 grand or 4 grand or something like that. So we need about $6,000 or $7,000. Where are we going to get that from? Well, how about DOCU, instead of 400 shares, we make it 300 shares. So let's go to the next slide, Howard.
Yeah.
That's exactly what we did. We reduced that 400, and this is now on the bottom right section of that spreadsheet titled the final setup, and we dropped that down to 303 contracts. Now, if we add up all our positions, it comes to 146,056, and we have a cash reserve of 3944, which is perfect for our 2 to 4% guideline.
What I love about that is that you have that is the manually entered, of course, which also makes a trader take a little bit more ownership when they have to enter their own numbers. It tends to give them a little bit more buy-in. So I do love that that is the way that that's done too. Makes a lot of sense here.
Yeah, and it makes it easier for the investor because they don't have to sit down and actually do all the calculations. They
Yeah.
just have to enter the information they glean from an option chain, takes them a minute, and then the spreadsheet does the rest of the work.
Absolutely. It definitely, as you've said, you've made this so that people, if you want to look at everything every day and be a very active investor, you can, but you also can take a step back, and it's something that either, depending on if you're playing weeklies or monthlies, that once a week, once a month, that you would need to take a look and spend a lot of time and maybe a few minutes a day just keeping an eye on what's going on. So it allows different levels of investors for their time basis to get involved in your systems.
Yeah, by the way, Howard, there's also a way of partially automating the exit strategy or position management aspect of a covered call trade. Uh, and that's we call that the 20%, 10% guideline, because if our enemy with a covered call is the price of the stock going down,
Right.
declining, obviously. Now, if the value of that stock goes down, and maybe at a subsequent discussion, we could talk in more detail about exit strategies. But if the price of the stock goes down, the option value will go down by its delta. And so a lot of times we could buy back the option at a greatly discounted price. So, for example, if we sold the option for $2 and it's in the first half of a monthly contract, we set up a buy to close good until cancel limit order at 40 cents, 20% of $2. So we
Right.
could just enter that in automatically. And if that threshold is reached, then automatically that option will be bought back and we'll get a notification from our broker that the
Yeah.
trade was executed. And then we could sit down and figure out what our next step is. So we could partially automate that aspect of the trade as well.
I love that. For me, I call that the set it and forget it. I used to love the Rondo set it and forget it ovens
Oh, yeah.
back in the
I'm
day. And I'm a big fan of that because it does make it just so much easier for the traders. All that is, just leads us to the spot here where it talks about your selection process and part of your ETF screenings. One of my takeaways too that I just saw is the ETFs do provide sometimes a little bit more of an affordable way to get into this also. Isn't that something you've brought up in our other previous discussions?
Yes, for those that don't have a lot of cash to put into an option portfolio, maybe they have 25, 35,000. It's very difficult to buy five different stocks.
Right.
You know, most not, stocks don't seem to split as often as they used to. Do you
Right.
find that? I mean, it's years ago you used to see them splitting quite a bit, but in any case, yes, for sure. If you get an ETF, if you have 35,000, let's say, and you get three ETFs, you're okay in your diversification.
Right.
Whereas if you get three different stocks, not so much. So you're absolutely right that if you have limited cash, then ETFs would be a strong consideration.
Great.
And we do with our ETF screening, Howard. We do ETFs that have relative strengths of 60 or greater, non-leveraged. I don't like to risk
Right.
leverage ETFs, and they must have beaten the S&P in both 1 and 3 month timeframes, and then and have adequate liquidity, trading
Right.
volume, and option liquidity. So
Sure.
those are the requirements, and if they pass those screens, they make our weekly list.
I love that because I think that's a huge takeaway for our listeners and viewers here is again, there is still a criteria that they're looking at when picking ETFs. You can't just pick a sector and a price and say, okay, I want an ETF that's trading at $30 or less, and it doesn't. That's not how we do it, and that's not how they do it. Is it's based upon actual criteria. It's outperformed the S&P, like you said, on the 1 month and the 3 months. So I do think that's important to stress too.
Sure, and you also need to look at liquidity because if you have very wide bid-ask spreads on low liquidity options, then you're not going to get very favorable trade execution. So
Right.
there are a bunch of things that you need to look at, and as I said, to a new investor, it'll look a little intimidating initially, but then as you do it more and more, it becomes second nature. And
That's
once you
exactly what I
become
was going to say. Is things that used to take me an hour to look at in the morning now take me, a matter of minutes. And you get your screen set up and you get your stuff and you realize, what volume matters, what doesn't. It is funny how that learning curve is not as bad as people sometimes think it is. But you do have to spend the time and the effort to do it and to follow what you guys are saying. Now, you guys go one step further where you provide a lot of these screeners so they don't even have to do it their own. Myself, I'm making a screener and I'm deciding based on whatever technical or financial considerations I'm looking at, all of those parameters. You guys are already doing a lot of that work for your clients, so that's great too.
Well, I used to do it for myself when I was, if you recall from the last discussion, a dentist doing
Yeah.
crown and root canals, and never thought that I'd be doing it for tens of thousands of people all over the world. But the screening process that we provide to our members is the same one that I've been using now for 30 years. I mean, I've improved on it over the
Right.
years, but it's exactly the same as what I've been using. And so now I share that, by the way, with everybody. So if people wanted to do this on their own, without becoming a member. They actually can, but by becoming a member, we just save them a ton of time because
Sure. Absolutely.
it's a good 15 to 20 hours to get just our stock report finished, which
Right, absolutely. That's and it's the most important part is finding this everything that hits the criteria. I think that beginning traders, let's say that there's 10 points we're supposed to be looking at on a screener to make sure it hits all of the criteria. What starts to happen sometimes is that you get too aggressive and they're too willing to sort of cut a corner. And you know what? It fills 7 of the 10 criteria, and I really like this stock, so we're going to go for it. And that tends to lead to losses, and that's what traders crash out, right?
that's true. Good point. Because if it doesn't meet all that criteria, our members never see that stock.
Right. That no, I mean that's huge because it is. There's a temptation from a lot of traders. I know I've done it where, number one, sometimes no trade is a trade, and it takes a while to understand that is, sometimes people overtrade, not necessarily with your strategy, but just in general. And then again, that, when people are anxious when they start a new program, they want to be part of it. You talked a little bit about it in the past where you say, hey, you got to start on paper trading, right? We tell all of our new traders it's paper trading, paper trading. It's not as easy as it, while it is easy for Dr. Allen here to go through and do this stuff, it isn't going to be that easy for a new member of, the blue collar investor. You have to crawl, walk, and then you can run.
Howard, I still remember the first option trade I executed in the mid 90s, and I had educated myself to some decent extent, not as good then as I am now, but I still remember my finger being stuck in midair before I hit the keyboard because I was scared to death to execute that trade.
Oh
Now,
yeah.
now
Yeah.
smoke is coming out of my keyboard as I'm doing dozens
Yeah,
of.
it is funny how that works, and I lived that life in the crypto world because if you move something from a wallet, you have to get that number or sequence exactly correct, and if you don't, it's gone, and there isn't, you can't call the helpline at Bitcoin to get it back. So you'd have this angst every single time, and now it's like copy paste, look at it one, I can do it in my sleep, so I know exactly what you mean. The same thing. I also once bought, sold. I think what no, I tried to do a call spread and I bought and sold the wrong sides of them. Because I didn't know what I'm doing. Because again, I didn't listen and I was watching CNBC during COVID, and somebody came on and said this is the hot trade, and I had a run to do it, and I looked, I did the opposite. The funniest takeaway from that, though, I have to tell you, is my trade actually won, and their trade was a big loser.
Well, you know something, Howard. I always tell my members that if you make a mistake, it's not necessarily a bad thing, as long as you learn from it and don't make
Right.
that mistake again. I mean, I developed this system almost literally by making mistakes. How could I have done better? What
Yeah.
could I have done to improve? And every day that I went along, I got better and better and better, made better guidelines, better rules, better spreadsheets. And so ultimately, here I am, president of the Blue Collar Investor, and having, given up my first professional
Right.
career to do something that I just love doing and speaking to people like you and hopefully giving information to your viewers that they find valuable.
Absolutely, you do. This is a strategy that it's like you said, proven over time. And what I love is that you don't just say my systems are perfect and it can never get better. You are always looking at it and saying, again, what could I have done better with this trade, and therefore maybe what should I have been looking at that I wasn't, or what did I miss here? I find that for me, who does a lot of scalping in trades, is so important. I've fine-tuned my risk reward management, and that's what's made me a successful trader. It wasn't necessarily picking differently than I was. It was fine-tuning for me my risk reward into that perfect sweet spot where it matched my success level and allowed me to be a profitable trader versus one that no longer has an account.
Yeah, well, if you think you know everything, that's
Yeah,
when you stop learning, and that's dangerous because
absolutely.
there's always something else, some little nugget or something that you could do that can improve the way you trade. So I agree with you 100% on that, Howard.
Awesome. Well, I know that you have some important things to do today. We've taken up a lot of your time already.
My
Thank you
pleasure.
so much for joining us. And I do know that I've already written down three more follow-ups for you. So we have a lot of sessions in front of us. Thank you so much for joining us, Dr. Alan Ellman, again, president of the Blue Collar Investors. Any last takeaways for us here as we enter, the end of the election period here?
Well, I would say what I've been doing with the election, because you never know, I kind of treat the election almost like an earnings report coming out. I just avoided it. I didn't
Yeah,
have any options in place in case any of the securities, I didn't want to cap them.
sure.
So what I'm doing is I'm just waiting for the post-election volatility to settle down, and then back I go. I have portfolios with weekly calls, monthly calls, weekly puts, and monthly puts. So
Yeah.
probably next week I'll get back on the option trail, but this week I didn't sell any options.
Makes sense, like you said, implied volatility. We saw it drop down pretty low today, although it was picking back up a little bit. Obviously, with everything moving up together, it kind of gives you a false reading there. So, again, thank you so much, and we will see you next week.
Thank you, Howard.